Question 1. Topic: Exclusions and limitations. A long-term care insurance policy typically has certain exclusions for coverage. Which of the following would most likely be excluded from a Vermont long-term care insurance policy? Their services provided in a foreign country outside of the United States. B. Home health care services provided by a licensed nurse. C. Hospice care for terminally ill patients. D. Adult daycare services in a certified facility. Answer: A. Services provided in a foreign country outside of the United States. Explanation: most long-term care insurance policies exclude coverage for services provided outside of the United States, unless explicitly stated otherwise in the policy. This is a standard exclusion found in many policies across various states, including Vermont. Coverage is typically limited to services provided within the U.S. to avoid issues with foreign healthcare systems and regulations. Options B, C, and D represent services commonly covered by long-term care insurance policies, particularly those that aim to support care at home or in certified facilities. Reference: Vermont-specific long-term care insurance regulations, NAIC Model Act. Question 2. Topic: Claims process and payment of benefits. Scenario: Mrs. Davis has a long-term care insurance policy and has been diagnosed with Alzheimer's disease. She requires in-home nursing care and occasional adult daycare services. She files a claim, but the insurer denies it, stating insufficient documentation. What should Mrs. Davis do next to appeal the denial? A. Reapply for a new policy with a different insurer. B. File an internal appeal and submit medical documentation that meets the policy's requirements. C. Ignore the denial and wait for further contact from the insurer. D. Immediately escalate the issue to a legal court. Answer: B. File an internal appeal and submit medical documentation that meets the policy's requirements. Explanation: when a claim is denied due to insufficient documentation, the policyholder typically has the right to file an internal appeal. Mrs. Davis should first check the requirements outlined in her policy, including the type of medical documentation required to support her claim. Many long-term care insurance policies require certification from a healthcare professional verifying the need for the covered services. If the internal appeal is denied, Mrs. Davis could pursue further action through an external review or legal recourse, but she should start with the insurer's appeals process as per NAIC and Vermont regulations. Reference: Vermont Department of Financial Regulation Guidelines, NAIC Model Act, Appeals Process for Claim Denials. Question 3. Topic: Policy replacement and conversion. Which of the following is the most critical factor that a Vermont policyholder should consider when replacing an existing long-term care insurance policy? A. Whether the new policy has a longer elimination period. B. The potential loss of benefits due to pre-existing conditions in the new policy. C. The reputation of the new insurance company in the market. D. The total annual premium of the new policy compared to the old one. Answer: B. The potential loss of benefits due to pre-existing conditions in the new policy. Explanation: when replacing a long-term care insurance policy, one of the most significant risks is the loss of coverage for pre-existing conditions. A new policy may impose waiting periods or exclude coverage for conditions that were covered under the old policy, especially if the new policy has stricter underwriting requirements. Although factors such as elimination periods, A. insurance company reputation, C. and premiums, D. are important, the potential loss of critical benefits due to pre-existing conditions is often the most detrimental to policyholders. Vermont's regulations and the NAIC Model Act emphasize suitability standards and protecting consumers in policy replacement situations. Reference: Vermont-specific rules for policy replacement, NAIC Model Act on long-term care insurance, suitability standards for replacement policies. Question 4. Topic: Benefit structure. Which of the following inflation protection options in a long-term care insurance policy offers the most comprehensive protection against rising costs of care over time? A. Simple inflation protection. B. No inflation protection. C. Compound inflation protection. D. Guaranteed renewable provision. Answer: C. Compound inflation protection. Explanation: compound inflation protection increases the benefit amount annually by a certain percentage, typically based on the prior year's benefit amount, providing more comprehensive protection against the rising cost of long-term care over time. This method is more robust than simple inflation protection, which increases benefits by a fixed percentage of the original benefit amount. Having no inflation protection, B, leaves policyholders vulnerable to cost increases, and the guaranteed renewable provision, D, refers to the policyholder's right to renew coverage without the insurance company cancelling it. unrelated to inflation. Reference NAIC Model Act, Vermont Long-Term Care Insurance Regulations, Inflation Protection Options. Question 5. Topic: Ethical considerations and consumer protections. Scenario: Mr. Thompson, age 68, meets with an insurance agent to discuss purchasing long-term care insurance. The agent recommends a policy but fails to disclose that the policy has a 2-year exclusion period for certain pre-existing conditions. What regulatory requirement has the agent potentially violated? A. The agent's duty to guarantee premium stability. B. The suitability standard for long-term care insurance. C. The disclosure requirements regarding policy features and limitations. D. The rule prohibiting offering insurance to individuals over 65 years old. Answer: C. The disclosure requirements regarding policy features and limitations. Explanation: Insurance agents are required to fully disclose the terms, conditions, and limitations of the policy, including exclusion periods for pre-existing conditions. Failure to disclose such critical details violates state and federal consumer protection laws, including Vermont's regulations. While suitability standards (B) are important in ensuring the policy fits Mr. Thompson's needs, the core issue here is the lack of transparency in explaining the exclusion period. Option D is incorrect because there is no rule prohibiting offering insurance to individuals over 65 years old. Reference Vermont Consumer Protection Laws, NAIC Model Act on Long-Term Care Insurance, Disclosure Requirements and Unfair Trade Practices. Question 6. Topic: Taxation of long-term care insurance. Which of the following is true about the tax treatment of long-term care insurance premiums for a self-employed individual in Vermont? A. Premiums are not deductible under any circumstances. B. Premiums can be deducted as a business expense subject to age-based limits. C. Premiums are only deductible if the policy covers both the individual and their spouse. D. Premiums can be deducted without limit for any policy purchased. Answer: B. Premiums can be deducted as a business expense subject to age-based limits. Explanation: Self-employed individuals can deduct a portion of their long-term care insurance premiums as a business expense subject to IRS age-based limits. The deduction increases with age, but the premiums must be for a tax-qualified policy. Option A is incorrect because deductions are available. Option C is incorrect as premiums can be deducted regardless of spousal coverage. Option D is incorrect because the deduction is subject to limits, not unlimited. Reference IRS Guidelines, Health Insurance Portability and Accountability Act, HIPAA, Vermont State Tax Rules. Question 7. Topic: Types of long-term care insurance policies. Which of the following is a characteristic of hybrid-linked benefit long-term care insurance policies? A. They are less expensive than traditional long-term care policies. B. They combine long-term care benefits with life insurance or an annuity. C. They are available only through employer-sponsored plans. D. They do not offer any death benefits. Answer: B. They combine long-term care benefits with life insurance or an annuity. Explanation: Hybrid or linked benefit policies combine long-term care insurance with either life insurance or an annuity. These policies offer the policyholder the option to use the benefit for long-term care services or provide a death benefit if the long-term care benefits are not fully utilized. Option A is incorrect because hybrid policies are often more expensive due to the combined features. Option C is incorrect as hybrid policies are available to individuals and not restricted to employer-sponsored plans. Option D is incorrect as hybrid policies often include death benefits. Reference Vermont-specific long-term care insurance regulations, NAIC Model Act, Hybrid Policy Guidelines. Question 8. Topic: Medicaid and long-term care. Under Vermont Medicaid rules, how does the state recover costs for long-term care provided to an individual who passed away? A. Medicaid cannot recover any costs from a deceased individual's estate. B. Medicaid can recover costs only if the individual has no surviving spouse or dependent children. C. Medicaid always recovers the total cost of care provided, regardless of circumstances. D. Medicaid recovers only a portion of the cost based on the individual's lifetime earnings. Answer: B. Medicaid can recover costs only if the individual has no surviving spouse or dependent children. Explanation: Under Vermont's Medicaid estate recovery rules, Medicaid can seek reimbursement from a deceased individual's estate for the costs of long-term care provided. However, if the individual has a surviving spouse, minor child, or disabled dependent child, Medicaid cannot recover costs until the spouse passes away or the dependent no longer qualifies. Option C is incorrect as there are specific protections for spouses and children. Option A is incorrect because Medicaid estate recovery is standard practice, and option D misrepresents how recovery works. Reference: Vermont Medicaid estate recovery rules and AIC guidelines. Question 9. Topic: Long-term care planning. What is one major financial risk of self-insuring for long-term care in Vermont? A. The inability to pass assets on to heirs. B. A lack of tax deductions for healthcare expenses. C. The potential for outliving retirement savings due to the high cost of care. D. The need to purchase additional health insurance to cover long-term care. Answer: C. The potential for outliving retirement savings due to the high cost of care. Explanation: One of the biggest risks of self-insuring for long-term care is that the costs can quickly deplete retirement savings, especially if long-term care services are needed for an extended period. The high cost of care in Vermont can make it difficult for individuals to cover these expenses without insurance, potentially leading to financial instability later in life. Option A may be a concern, but the primary risk is financial exhaustion. Option B is not relevant to long-term care self-insurance, and option D is incorrect because additional health insurance generally does not cover long-term care. Reference: Vermont Long-Term Care Planning Guidelines, Financial Planning Considerations for Long-Term Care. Question 10. Topic: State and federal regulations. Which of the following is a prohibited practice under Vermont long-term care insurance regulations? A. Offering policies with limited benefit periods. B. Misrepresenting policy features during the sales process. C. Offering policies that do not include a waiver of premium provision. D. Requiring medical underwriting for all applicants. Answer: B. Misrepresenting policy features during the sales process. Explanation: Misrepresenting policy features, terms, or benefits during the sales process is strictly prohibited under Vermont long-term care insurance regulations and NAIC guidelines. Such practices are considered unfair trade practices and can result in penalties for agents or insurers. While limited benefit periods A and medical underwriting D are common practices, misrepresentation B is unethical and illegal. The waiver of premium provision C is a desirable feature but not required by law. Reference: Vermont Consumer Protection Laws, NAIC Model Act on Long-Term Care Insurance, Unfair Trade Practices Regulations. Question 11. Topic: Long-term care insurance eligibility. Scenario MS. Parker has been diagnosed with a progressive neurological condition that is expected to limit her ability to perform daily activities over time. When applying for long-term care insurance, what factor is most likely to impact her eligibility? A. Her income level. B. Her age at the time of application. C. Her ability to perform activities of daily living. Adults. D. The type of health insurance she currently holds. Answer: C. Her ability to perform activities of daily living. Adults. Explanation: Eligibility for long-term care insurance often depends on an individual's ability to perform activities of daily living. Adults, such as bathing, dressing, and eating. Insurers assess these factors when determining coverage and premiums. MS. Parker's neurological condition could affect her eligibility if it limits her. Adults. Her age B may influence premium rates, but ADLS are the primary consideration. Income level A and current health insurance D do not directly affect long-term care insurance eligibility. Reference: NAIC Model Act, Vermont Long-Term Care Insurance Regulations, ADL eligibility criteria. Question 12. Topic: Policy non-forfeiture benefits. Which of the following is a benefit of including a non-forfeiture option in a long-term care insurance policy? A. Low premiums from the start of the policy. B. The ability to receive partial benefits if the policy lapses. C. Coverage for pre-existing conditions without a waiting period. D. Guaranteed approval of claims regardless of medical conditions. Answer: B. The ability to receive partial benefits if the policy lapses. Explanation: A non-forfeiture option ensures that if the policyholder stops paying premiums or the policy lapses, they will still receive some partial benefits. This protects individuals who may not be able to continue paying premiums later in life. Low premiums are not associated with non-forfeiture options. In fact, adding this option may increase premiums. Coverage for pre-existing conditions C and guaranteed approval of claims D are unrelated to non-forfeiture benefits. Reference: Vermont Long-Term Care Insurance Non-Forfeiture Options NAIC Guidelines. Question 13. Topic: Consumer protections under Vermont Long-Term Care Insurance Regulations. How long is the free look period during which a policyholder can cancel the policy and receive a full refund? A. 10 days. B. 30 days, C. 45 days, D. 60 days. Answer: B. 30 days. Explanation: Vermont requires a 30-day free look period for long-term care insurance policies. This allows the policyholder to review the policy and cancel it for any reason within 30 days to receive a full refund. The other time frames, A, C, D, are incorrect based on Vermont regulations. Reference: Vermont State Regulations on Long-Term Care Insurance, NAIC Model Act Free Look Period. Question 14. Topic: Medicaid and asset protection. In Vermont, which of the following strategies is used to protect assets when qualifying for Medicaid long-term care benefits? A. Purchasing a standard long-term care insurance policy. B. Gifting assets to children within 1 year of applying for Medicaid. C. Setting up an irrevocable trust more than 5 years before applying. D. Selling all assets to qualify for Medicaid. Answer: C. Setting up an irrevocable trust more than 5 years before applying. Explanation: Medicaid has a 5-year look-back period during which asset transfers are scrutinized. Setting up an irrevocable trust more than 5 years before applying for Medicaid can protect assets from being counted when determining Medicaid eligibility. Gifting assets within 1 year. B. Would likely trigger penalties, and selling all assets. D. Is unnecessary if proper planning is done. A standard long-term care insurance policy, A, may help avoid Medicaid reliance but does not directly protect assets in this context. Reference: Vermont Medicaid long-term care rules, irrevocable trusts 5-year look-back period. Question 15. Topic: Partnership policies. What is the primary advantage of a Vermont partnership long-term care insurance policy? A. Premiums are significantly lower than traditional policies. B. Policyholders are exempt from paying federal income taxes. C. It allows policyholders to protect assets and still qualify for Medicaid. D. The policy guarantees full reimbursement for all long-term care costs. Answer: C. It allows policyholders to protect assets and still qualify for Medicaid. Explanation: Partnership policies are designed to allow individuals to protect a portion of their assets equal to the amount of benefits paid out by the policy if they later need to qualify for Medicaid. These policies are a valuable tool for asset protection. While premiums they may vary and some tax advantages exist, the primary benefit is the asset protection feature. Full reimbursement, D, is not guaranteed by these policies. Reference: Vermont Long-Term Care Partnership Program, NAIC Partnership Guidelines. Question 16. Topic: Tax qualified policies. Which of the following is a requirement for a long-term care insurance policy to be considered tax qualified under federal law? A. It must cover all medical conditions without exclusions. B. The policyholder must be guaranteed eligibility for Medicaid. C. Benefits must be triggered by an inability to perform, at least 2 adults. D. It must offer lifetime coverage without limitations on benefit periods. Answer: C. Benefits must be triggered by an inability to perform, at least 2 adults. Explanation: To be considered tax qualified under federal law, long-term care insurance policies must provide benefits when the policyholder is unable to perform at least 2 activities of daily living, adults, or suffers from cognitive impairment. The other options, A, B, D, do not meet the specific federal requirements for tax qualification. Reference: IRS Tax Qualified Long-Term Care Insurance Guidelines, HIPAA regulations. Question 17. Topic: Policy features. Which policy feature allows a Vermont long-term care insurance policyholder to use home care services instead of being confined to a nursing home? A. Restoration of benefits. B. Non-forfeiture option. C. Waiver of premium. D. Home care benefit. Answer: D. Home care benefit. Explanation: A home care benefit allows policyholders to receive long-term care services at home, which is often a more desirable option than institutional care. The other features listed: restoration of benefits, A, non-forfeiture, B, and waiver of premium, C, do not specifically address the option of home care. Reference: Vermont Long-Term Care Insurance Policy Features, NAIC Model Act. Question 18. Topic: Premium rate increases in Vermont. Which of the following is true regarding rate increases on long-term care insurance policies? A. Rate increases are prohibited once the policy is in effect. B. Insurers must provide at least 60 days notice before increasing rates. C. Policyholders can opt out of the increase without losing coverage. D. Premiums can only be increased after the policyholder turns 70. Answer: B. Insurers must provide at least 60 days notice before increasing rates. Explanation: Vermont regulations require that insurers provide policyholders with at least 60 days notice before implementing a rate increase. Policyholders do not lose coverage due to rate increases, but may have to pay higher premiums. Rate increases A are not prohibited, and C does not apply as opting out of rate increases typically involves changes in coverage or benefits. Premium increases are not tied specifically to age. D. Reference Vermont Long-Term Care Insurance Regulations, Rate Increase Requirements. Question 19. Topic: Care Coordination Benefits. What is the purpose of care coordination services in a Vermont long-term care insurance policy? A. To directly provide long-term care services. B. To help policyholders identify appropriate care providers and services. C. To reduce premiums through early intervention. D. To automatically extend the benefit period without additional costs. Answer: B. To help policyholders identify appropriate care providers and services. Explanation: Care coordination services assist policyholders in navigating the complexities of finding suitable care providers and services. These services do not directly provide care but help manage the process. They do not reduce premiums. C. Or extend benefit periods. D. Reference Vermont Long-Term Care Insurance Policies, Care Coordination Benefits. Question 20. Topic: Elimination periods. An elimination period in a Vermont long-term care insurance policy refers to A. The number of days the policyholder must pay for care before benefits begin. B. The period during which premiums are waived due to claim filing. C. The time frame when the insurer can cancel the policy for any reason. D. The period when care must be received at home to qualify for benefits. Answer: A. The number of days the policyholder must pay for care before benefits begin. Explanation: An elimination period, also known as a waiting period, is the number of days a policyholder must pay for care out of pocket before the insurance benefits start. This is similar to a deductible in health insurance. It does not involve premium waivers. B. Or policy cancellation. C. Option D misinterprets the elimination period. Reference Vermont Long-Term Care Insurance Policy Terms, NAIC Guidelines on Elimination Periods. Question 21. Topic: Long-Term Care Partnership Program. Vermont. In the context of Vermont's Long-Term Care Partnership Program, what does the term dollar-for-dollar asset protection mean? A. For every dollar the policyholder spends on premiums, the state covers an additional dollar of care. B. For every dollar of long-term care benefits paid, an equivalent amount of the policyholder's assets is protected from Medicaid spend-down requirements. C. The policyholder can transfer assets up to the amount of the total insurance benefits without penalty. D. The policyholder receives a dollar-for-dollar refund if they cancel the policy. Answer: B. For every dollar of long-term care benefits paid, an equivalent amount of the policyholder's assets is protected from Medicaid spend-down requirements. Explanation: Under the Long-Term Care Partnership Program, dollar-for-dollar asset protection allows policyholders to protect assets equal to the amount of benefits their policy pays, without those assets being considered when determining Medicaid eligibility. This helps individuals preserve their savings while still qualifying for Medicaid if they exhaust their insurance benefits. Reference Vermont Long-Term Care Partnership Program Medicaid Asset Protection Guidelines. Question 22. Topic: Inflation Protection Requirement. Vermont. Which of the following is required for a long-term care insurance policy to comply with Vermont's inflation protection rules for individuals under age 61? A. A 3% annual compound inflation adjustment. B. A 5% annual compound inflation adjustment. C. A 2% annual simple inflation adjustment. D. No inflation protection is required for this age group. Answer: B. A 5% annual compound inflation adjustment. Explanation: Vermont regulations require that long-term care insurance policies offer a 5% compound inflation adjustment to protect against rising long-term care costs, particularly for individuals under the age of 61. This ensures that the policy's benefits will keep pace with the cost of care over time. The other options provide inadequate inflation protection under Vermont law. Reference Vermont Long-Term Care Insurance Inflation Protection Rules, NAIC Guidelines. Question 23. Topic: Premium refund upon death. If a Vermont long-term care insurance policyholder dies before using any benefits, what typically happens to the premiums they have paid? A. The premiums are refunded to the beneficiary. B. The premiums are retained by the insurance company. C. A portion of the premiums is refunded depending on the policy's provisions. D. The premiums are applied to cover the policyholder's final expenses. Answer: C. A portion of the premiums is refunded depending on the policy's provisions. Explanation: Some long-term care insurance policies offer a premium refund upon the policyholder's death, typically returning a portion of the paid premiums to the beneficiary depending on the policy terms. However, not all policies offer this feature, and it must be explicitly included as part of the policy provisions. Reference: Vermont Long-Term Care Insurance Policy Terms and NAIC Guidelines on Premium Refunds. Question 24. Topic: Rescission of policies under Vermont Long-Term Care Insurance Regulations. An insurer may rescind a policy within the first 2 years if A. the policyholder misses more than 2 premium payments, B. the policyholder moves to another state, C. the policyholder may a material misrepresentation on the application, D. the policyholder files a claim for benefits earlier than expected. Answer: C. The policyholder made a material misrepresentation on the application. Explanation: in Vermont, an insurer can rescind a long-term care insurance policy within the first 2 years if the policyholder made a material misrepresentation or omission during the application process. This ensures that the insurer can deny coverage if the application was not truthful. Missing premium payments A. would lead to policy lapse, not rescission, and moving to another state, B. or filing a claim, D. does not typically result in rescission. Reference: Vermont Long-Term Care Insurance Policy Rescission Rules, NAIC Guidelines. Question 25. Topic: Waiver of premium benefit. What does the waiver of premium benefit in a Vermont long-term care insurance policy provide? A. The policyholder can stop paying premiums while receiving benefits. B. The insurer refunds all premiums paid once the policyholder starts receiving benefits. C. The premiums are permanently reduced after the first claim is filed. D. The policyholder's premiums are automatically refunded if they are hospitalized. Answer: A. The policyholder can stop paying premiums while receiving benefits. Explanation: a waiver of premium benefit allows policyholders to stop paying premiums while they are receiving long-term care benefits. This prevents the financial burden of continuing to pay for the policy during a time when the insured is already incurring care-related expenses. There is no automatic refund, B. or reduction, C. and the benefit is not tied to hospitalization. D. Reference: Vermont Long-Term Care Insurance Policies Waiver of Premium Provisions. Question 26. Topic: Partnership policy versus traditional policy. Which key difference distinguishes a Vermont long-term care partnership policy from a traditional long-term care insurance policy? A. A partnership policy covers more services than a traditional policy. B. A partnership policy qualifies the policyholder for additional Medicare benefits. C. A partnership policy allows the policyholder to protect assets from Medicaid spend-down requirements. D. A partnership policy has lower premiums than a traditional policy. Answer: C. A partnership policy allows the policyholder to protect assets from Medicaid spend-down requirements. Explanation: the key distinction of a Vermont long-term care partnership policy is the ability to protect a portion of assets from Medicaid spend-down requirements if the policyholder exhausts their insurance benefits and needs Medicaid assistance. This asset protection feature is not available with traditional long-term care policies. The other options, A, B, D, do not accurately reflect the differences. Reference: Vermont Long-Term Care Partnership Program, NAIC Guidelines. Question 27. Topic: Continuation or conversion rights under Vermont law. If a long-term care insurance policy is terminated due to non-payment of premiums, what continuation or conversion right does the policyholder have? A. None. The policy is fully terminated without recourse. B. The policyholder may convert the policy to a reduced benefit plan. C. The policyholder can reinstate the policy within 1 year by paying back premiums. D. The policyholder may apply for a new policy with the same insurer. Answer: B. The policyholder may convert the policy to a reduced benefit plan. Explanation: Vermont law provides policyholders with the right to convert their long-term care insurance policy to a reduced benefit plan if it is terminated due to non-payment of premiums. This ensures the policyholder retains some level of coverage. Full reinstatement, C, is not typically allowed after termination, and there are no automatic rights to a new policy. D. Reference: Vermont Long-Term Care Insurance Continuation and Conversion Rights, NAIC Guidelines. Question 20. Topic: Eligibility for benefits. Cognitive impairment. In a Vermont long-term care insurance policy, which of the following cognitive impairments would typically trigger eligibility for benefits? A. Mild forgetfulness. B. Occasional confusion when driving. C. Moderate Alzheimer's disease. D. Difficulty recalling names. Answer C. Moderate Alzheimer's disease. Explanation. Moderate Alzheimer's disease, which severely impacts the ability to perform activities of daily living and requires assistance, is a common trigger for long-term care insurance benefits. Mild forgetfulness, A. Occasional confusion, B. And difficulty recalling names, D. Generally do not meet the threshold for benefits. Reference. Vermont long-term care insurance policies. Cognitive impairment benefit triggers. Question 29. Topic: non-forfeiture benefits. What is the primary purpose of non-forfeiture benefits in a Vermont long-term care insurance policy? A. To provide lifetime coverage regardless of premium payments. B. To guarantee a full refund of premiums upon policy termination. C. To allow the policyholder to retain reduced benefits if the policy lapses. D. To eliminate the need for an elimination period. Answer C. To allow the policyholder to retain reduced benefits if the policy lapses. Explanation. Non-forfeiture benefits provide policyholders with reduced benefits even if they stop paying premiums and the policy lapses. This ensures that some coverage remains in effect, offering protection despite the lapse. Lifetime coverage, A, and refunds, B, are not guaranteed, and elimination periods, D, are unrelated to non-forfeiture provisions. Reference. Vermont long-term care insurance policies, non-forfeiture benefits. Question 30. Topic: elimination periods. Scenario: Mr. Taylor has a Vermont long-term care insurance policy with a 90-day elimination period. He enters a nursing home on January 1st. How long must Mr. Taylor pay for care out of pocket before his insurance begins to pay? A. 30 days, B. 60 days, C. 90 days, D. 120 days. Answer C. 90 days. Explanation. An elimination period is the time the policyholder must wait and pay for care out of pocket before insurance benefits begin. In this case, with a 90-day elimination period, Mr. Taylor must pay for care for 90 days starting from January 1st before his long-term care insurance coverage begins. Reference: Vermont long-term care insurance policy terms, elimination periods.